Good morning. Welcome to our session for today. Very sorry we couldn't meet the other weekend, so we're going to continue today. We'll finish off on errors and accounting estimates. Then we should start on provisions. And I hope you read the notes that I sent on provisions because of the time. I will just go straight to the answering. Then I will explain through the answering. So you can use the notes that I sent to you. So we'll do events after the reporting period and provisions. Then next week I will try also to do a longer session because I think our days for the exams are already out. So our exams are near. So we need to do what I'm going to do today, and we still have to do fair value measurement. Revenue we've already dealt with it. So after this, we'll have with fair value measurement. So and I'll organize some revision class towards the exam, maybe a weekend before. I'll organize a longer revision class. I think it should be around the 8th or something like that. I'm not very sure the date. I will verify and I'll tell you on the groups. Right. So today we're going to continue with the errors that we're dealing with. Let me just close some of my applications. Right. We had done changes in accounting policy. We're now on errors. And we had dealt with question 4 on errors. So let's look for right. Let's do question 6. Right. Now, Plastics Limited is a manufacturer of a wide range of plastics products. The annual financial statements of Plastics Limited for the year ended 30 September 2018 will be presented to the Board of Directors for authorization for issue on 25 October 2018. You are presented with the following additional information. So the financial year is ending 30 September 2018. Right. On 1 October 2017, the carrying amount and tax base of manufacturing equipment acquired on 1 October 2014 amounted to 480,000 and 240,000 respectively. That is at the beginning of the year. Depreciation and the tax allowance on the manufacturing equipment for the current year both amounted to 240,000. So the depreciation is 240. Plastics Limited depreciates manufacturing equipment at 20% per annum according to the certain method. The SA Revenue Service grants a Section 12C allowance on manufacturing equipment in terms of the Income Tax Act, allowing a 40% deduction in the first year it is brought into use, and thereafter a 20% per annum for the next 3 years. The Section 12C allowance is not apportioned for part of a year. Right. On 30 September 2018, the directors of Plastics Limited re-estimated the useful life of manufacturing equipment and determined that the useful life on acquisition date of the manufacturing equipment is actually 8 years due to the implementation of new improved maintenance plan. The residual value of the manufacturing equipment remains unchanged at nil. This one I'm going to look at it later. The part that we want to look at is this one. During the year ended 30 September 2018, the accountant of Plastics Limited discovered that manufacturing equipment with a cost price of 500,000, which was originally acquired on 1 October 2016, was incorrectly recorded as other operating expenses. So they bought equipment, but unfortunately they recorded it as an expense instead of recording as an asset. Right? The SA Revenue Service indicated that they will not reopen the 2017 not reopen the 2017 tax assessment regarding this matter. The SA Revenue Service allowed all other operating expenses as a deduction for the 2017 tax year. The above mentioned re-estimation of the useful life of manufacturing equipment, as well as the incorrect allocation of manufacturing equipment as other operating expenses, have not been recorded yet in the accounting record of plastics. No other manufacturing equipment was purchased or sold since 1 October 2016. The SA normal tax rate is 28%. The government provides for deferred tax on all temporary differences according to the statement of financial position approach. There are no exempt or temporary differences except those mentioned in the question. There is certainly beyond any reasonable doubt that the company will have sufficient taxable profit in future against which any deductible temporary differences can be utilized. Assume all amounts are material. Ignore the implications of that. Right. So they want us to disclose in the notes. Right. There are two things here, but as I said, the other one, I'll come back to it now. There is the issue of changing the useful life. It will affect what we call the change in accounting estimate. I will explain it in a short while. But our main issue here is the prior period error, which is the recording of manufacturing equipment as operating expenses, right? If you make an error in the previous periods, just to recap, remember we said that the error will be disclosed in the notes to the financial statements. And correction of an error results in retrospective application. That means we go back to where the error was made and correct it. Then going forward, then we will recognize the expense, like we then recognize the effect on the financial statements, the effects on the financial statements. Right, so we want to do the prior period error not right. Right, we have question 6. We have extract of the notes, the financial statements. Of Plastics Limited. For the year ended 30 September 2018. Right, the note will be the prior period error. Right, if an error, a prior period error note, remember, it's about errors that were made in the previous periods. Errors made in the current year, we don't do a prior period error. We just correct the financial statements because we'll still have a chance to correct it. So when we talk about prior period error, we're talking about errors that happened in the previous financial years, which can have an effect on the current year financial statements. All right. So first of all, you describe the error. So we can say correction of manufacturing machinery acquired, which was incorrectly recorded as other expenses in the prior year. The comparative amounts, this is a standard statement, have been appropriately restated. the effect of this error on the results of 2017. We're in 2018, but this one is affecting 2017. Is as follows. Right. Let's remember that first of all, we show the effect on the statement of profit or loss. Right. In the profit or loss, that means there are two things that can be affected. So remember that I said for errors, you have to have your knowledge of your basic accounting for you to know how to correct. Right. So if an asset is wrongly treated as an expense, that means our expenses are overstated. That's number one, by the amount. Then number two, since that asset was not considered to be PPE, that means they didn't depreciate it. So there will be an issue of what? Of depreciation also. Right. So there will be two expenses that will be affected there. That is one relating to the right. So what we'll do here would say just a second. Right. Right. So would say a decrease in other expenses. Right. Now, let me just explain how the decrease comes into being. Number one, this machine had been treated as other expenses. So we have to reduce those expenses by 500,000. So we have our manufacturing equipment, 500,000. So it will have to decrease our expenses by 500,000. But at the same time, they have to be increased by the depreciation. They have to be increased by the depreciation. Remember, they are saying that they didn't, because they treated it as an expense, they didn't provide depreciation. So we can have an increase due to depreciation. This one will be determined by the policy of the company in terms of providing for depreciation. So please remember that when an asset, a depreciable asset, is incorrectly recorded as an expense, there will be two expenses involved. That means the total amount will have to be reduced from expenses, and at the same time, there will be the effect of depreciation. Right? Their policy, we're told that they were using 20% per annum according to the straight line. That was before the change. We don't talk about the change because the change was for this year. So say 20% multiplied by 500,000, which is 100,000. Then we can be able to get our decrease in expenses. There's a decrease and an increase. So that's why they are subtracting each other. One is a decrease, the other one is an increase. So the net effect would be a decrease in expenses of 400,000. So we're supposed to decrease our expenses with 400,000. Right. The next thing will be the tax effect. The next thing will be the tax effect. Right. When you decrease your expenses, your taxable income, when you decrease your expenses, your profit will go up. Now, because your profit has gone up, there will be an increase in this expense. The tax expense can be either current tax or deferred tax. It is current tax if SARS have agreed to reopen and they will recognize the same amount. And it is deferred tax if SARS do not agree to reopen or they've agreed but the amounts to be recognized are different. Now we have been told that the SA Revenue Service indicated that they will not reopen. Because they will not reopen, we, according to the financial statements, were correcting, but them at SARS are not correcting. So there will be what we call a temporary difference. So that will result in deferred tax. So as long as SARS do not agree to reopen, then it will be deferred tax instead of current tax. Right. But if SARS had agreed, and but in this case, still, even if SARS had agreed, it was going to be deferred tax. Why? Because SARS are not using the depreciation of 20%, they are using 40% in the first year. But as long as they say SARS do not agree to reopen, then you know that there's deferred tax. And we have to calculate that deferred tax based on last year's tax rate. Right. There were no changes, so we just use the 28%. So same apply by 28%. What do we get? $112,000. So that would be right. Then we get our increase in profits. The fact that our expenses are going down, that means our profit is going to increase. So there's an increase in profit, which will be the difference between those two. Right. So that will be the effect on our statement of profit or loss. Right. Then you also have to show the effect on the statement of financial position. We have to increase our property, plant, and equipment because we now have to transfer that asset to the property, plant, and equipment. Right, by 400,000. We increase it by the cost of 500, but there will also be a reduction of the depreciation of 100,000. Right. Now, when we increase our equipment, there will also be an increase in deferred tax liability. But if SARS have agreed to reopen, it was going to be deferred tax asset. If SARS had agreed to, sorry, it was going to be current tax liability. If SARS had agreed, it was going to be current tax liability. But because SARS did not agree, then it will be deferred tax. So please, that statement is very important on how you are going to structure your note and what you are going to recognize. Right. Then we'll get our effect on what? Equity. There will be an increase in equity because of the increased profits. So your knowledge of double entry will be handy. Your basic double entry, because it is the one that will inform you which accounts will be affected under the circumstances. Right. Any questions? All right, we'll go to the next one. Right. Let's do question 7. All right. Tires for You Limited is a South African company that manufactures and sells tire to retail stores countrywide. The profit before tax on Tires for You for the year ended 28 February 2018 amounted to 2,377,253. Before taking into account information, the 47 below, ignore that 4727. Right, the first part I'm going to ignore it for now. It's a change in accounting estimate. We'll start from number 2. On 1 March 2016, Tires for You paid 126,000 for insurance of the above mentioned delivery truck. All right. That is on 1 March 2016. Our year is ending 28 February 2018. The insurance remittance advice indicated that the insurance payment was in respect of the following periods. So that means 60,000 was for last year, 2017, and 66,000 was for this year, to make it the 126. Then the inexperienced financial accountant recorded the total insurance payment of 126,000 as prepayments in the statement of financial position of Tires for You Limited for the year ended 28 February 2017. The insurance payment of 126,000 was correctly deducted for current tax purposes for the year ended 28 February 2017. No adjustments relating to the insurance payment have been taken yet into account. Accounting records. Tires for You, right? The SA tax rate remained unchanged. Right. Now, what is the error here? The error is that the accountant was supposed to only recognize the expense of 60,000. The other prepayment of 66 was not supposed to be recognized as an expense. So the issue is not about the whole 126, it's only about the 66,000, which was wrongly included in expenses because they said he recorded the total insurance payment as prepayment. Sorry. He recorded it as prepayment. So the issue is not the 66, it's the 60. Because not all the amount is a prepayment. The 60 is for 2017, so it was not supposed to be the prepayment. The prepayment was only supposed to be what? 66. So the issue is on the 60. It was wrong to include that as a prepayment. It was supposed to be regarded as an expense directly in that financial year because that payment pertained to the 2017 financial year. Is that fine? Right, so we can do our note. Extract of the notes, the financial statements. Tires for You Limited. For the year ended 28 February 2018. Prior period error. So you write the name of the note. Did I do that on the previous one? You don't just start to write. I think here I didn't. we're supposed to write that this is our prior period error. Oh, I wrote at the top. I didn't see, sorry. I had written here. Right. First of all, remember, we have to write what we said there. Right. Right. So would say correction of insurance expense incorrectly treated as prepaid expense. Right. In the prior. Right. The comparative amounts have been appropriately restated. The restatement is the one that we'll be doing down there. And the effects of the error on the results of 2017. So now we show our error. Remember that we start on the effect on the P&L. Right. So we have to increase in other expenses. Which is 60,000. Right. Then when we increase an expense, there will be a decrease in what? Current tax expense. Right. There's a decrease in current tax expense because SARS already, we're told that SARS already correctly deducted the full amount. Right. They was correctly deducted for current tax purposes. So that means for current tax purposes, it was correct. So there will be an agreement. So that's why we don't use deferred tax. Instead, we use what? Current tax. Right. So we're going to say 60,000 times 28%. But if SARS were not going to, maybe if they said SARS, it had not been correctly deducted for tax and SARS will not reopen, we're going to use deferred tax again. What do you get? Thank you so much. 16,800. And when our expenses increase, we know that our profit will decrease. Right. Then we go to the statement of financial position. We then correct the entry in the statement of financial position. Right. In the statement of financial position, remember they included it as a prepayment, which is an asset. So we'll have to decrease in prepaid expenses, which is the 60,000. Then we'll have our decrease in current tax liability. Right. Then at the end of the day, because of the decrease in profit, we'll have our decrease in equity. Because our profits have gone down. Remember that the profits for last year would affect your retained earnings. So your retained earnings at the beginning of the year will be lower, which will reduce your equity. So it's all about knowing the items that are, you have to know that, okay, to correct this, what do I do? So I have to take this, I have to take it out of prepayment where it was wrongly included and include it in expenses. A prepayment is an asset, so it will be on the bottom part, whereas the expense is it's an P&L item, so it will be on the top part. So your thinking should be what was supposed to be the correct. Is that right? So you have to do two things: reverse the wrong entry and make the correct entry. So to reverse the wrong entry was to decrease this prepaid expense because it was wrong to include the prepaid expense. And to do the correct thing is to include it in other expenses because this amount was supposed to be an expense. Any questions? Right. If on this question, if they said that they'd included the 126 in expenses instead of prepayment, if they said in expenses, the issue was going to be about this one. That means we're going to reduce the expenses and increase the prepayment instead. If they'd said they'd included in expenses, but they said they'd included it in prepayments. So that's why our issue was now on this one, which was not supposed to be a prepayment. Right, so we'll move on. Question 8. The annual financial statements of Laduma Limited, a manufacturer of machines for the year ended 31 August 2017, were presented to the board of the directors for authorization for issue on 30 September 2017. Laduma Limited specializes in machines that manufactures various types of balls, such as cricket, soccer, rugby balls. Additional information. The following transactions have not yet been recorded in the accounting records of Laduma Limited for the year ended 31 August 2017. Right, the first one, we already did it. The change in accounting policy. Right, our issue is on this one here. Right, it is compulsory for all the staff members of Laduma Limited to be members of the Bonox Medical Aid Scheme During the current year's audit of the staff costs, it was discovered that since 1 September 2014, medical aid contributions made on behalf of staff members were incorrectly debited to the accounts receivable account instead of the salaries and wages account. So they were supposed to be salaries and wages, but instead they were wrongly entering in the accounts receivable. So already in your mind, you know that on the statement of financial position, I should reduce my accounts receivable. On the P&L side, I should increase my salaries and wages. Right, the medical aid contributions in respect of the staff were correctly credited to the medical aid contribution account and paid over to the bonus medical aid scheme. An analysis of the accounts receivable account on the respective year ends as follows. Right, so our issue is on these amounts here. They were not supposed to be part of trade debtors. They were supposed to be salaries and wages. So we have to increase our salaries and wages and reduce our trade debtors. Right, the effect therefore is considered material. The SARS Revenue Service indicated that they will reopen the tax assessments for the prior year. As long as SARS will reopen there, then we know that it will affect current tax and not deferred tax. Right, the company provides for deferred tax on all. Okay, that one is the standard statement. The SA normal tax rate remained unchanged at 28%. Right. Question 8. Extract of the notes, the financial statements of Laduma Limited for the year ended at 1 August 2017. Then we'll do our extract of the notes to the financial statements. Oh, that's what was happening here. I'm supposed to write, sorry about that, prior period error. That's correction of salaries and wages wrongly debited to trade receivables. Comparative amounts have been appropriately restated and the effect of this error on the results of the previous years is as follows. Right, here I didn't specify the year because we've got 2 years that we have there. Right, my friends, we are doing the books for 2017. So here there will be no prior period error here, because this one we're still doing those books, so we can just go in the books and correct them before we publish the financial statements. So the prior period error only refers to the previous periods, because we still have a chance to correct our books for the current period. So our error is only on these figures here, 2016 and 2015, and here we've got 2 years, unlike the other question that we had 1 year. So they would show both years. 2016, 2015. Right. Salaries are part of expenses. So we have to increase in other expenses. We just say other expenses because we know that normally maybe you can say increase in admin expenses or whatever. It will still be correct. Or you can just say increase in expenses. Right. For 2016, there will be what? 450. And for 2015, there will be 410. 450,900 and 410,000. Right. When your expenses you have to increase, right? We're increasing expenses because an expense was wrongly included in trade receivables, so they didn't record that expense. So when your expenses increase, then your profits will go down and your tax will also go down. So there'll be a decrease in what? Income, current tax expense. It's current because SARS agreed to reopen. It's current because SARS agreed to reopen. So they have two calculations here: 450,900 times 28%. There was no change in tax rate. So you should be very careful. If there was a change in tax rate, you use the tax rate that was applicable in those years. So if they said that it was 29% in the previous years, we're going to use 29%. Right, what do we get? Right, we have 126,252 and 114,800. Thank you so much. So that will be 126,252 and 114,800. Right. Then we get our effect on the profit. Remember, when our expenses increase, our profit will decrease. That will be the effect on the P&L. Then our effect on the statement of financial position, we have to decrease trade receivables because it was wrong to include those amounts in trade receivables. That's 450, 900, 410,000. Then we have decrease in current tax liability because of the reduced taxable income. We'll have our right. Then we have our decrease in equity because of the decrease in profits. Any questions? All right, I think we have tried to do as much as possible on as far as changes, errors are concerned. So errors are mainly to know your basic double entry, because that is the one that will tell you that where is the error. So if we don't have any questions, I would move on to changes in accounting estimates. I'll move on to changes in accounting estimates. Right. Now we know that in accounting, there are things that are estimated. There are things that are estimated because it's sometimes it's impossible to measure with certainty. So we have to make an estimate. As a good example is depreciation. For you to accurately measure depreciation, it's next to sorry, just a second. Right. So those things have to be estimated. You have to make a reasonable estimate. Now, because you are making an estimate, there can be circumstances in future whereby you now see that your estimate was actually wrong, and you now have to change the estimate. So maybe we're using a useful life for 4 years, but you see that with the state of your vehicles, the useful life might have reduced because of accidents. Then you reduce the useful life because of those circumstances. So when that happens, that's where we have a change in accounting estimate. Right. So let me just give you examples of estimates that are in the standard. Right. The examples of estimates. We have allowance for credit losses. Obsolete inventory allowance. Useful lives. And useful lives and residual values. PPE. Depreciation methods. Warranty obligations. So we're saying these items, normally we have to expect estimate because we can't verify them with certainty. Right. Now, a change in accounting estimates is accounted for prospectively and not retrospectively. If you saw on the error and the change in accounting policy, we were accounting for them retrospectively. When we say retrospectively, we mean we adjust the previous years. But for a change in accounting estimate, we don't adjust the previous years. We only start to adjust from the current year. So we're saying only the current year and future periods may be affected by the change. And the previous period will not be affected. Right. Right. Disclosure. This can be disclosed either in the profit or loss from operating activities. Without closing them separately. Where the effect of doing that, so we will not do a separate note for it. We can just include it in within profit before tax. Then or including in operating activities. And disclosing them separately. Items requiring separate disclosure. For example, when we talk about segments. So these are the two ways. But in our module, normally we just show them with the profit before tax. So we just show them together with the profit before tax, as you shall see when I answer the questions. Right, the disclosures that should be made, the following should be disclosed when there's a change in accounting estimates. The nature of the change, the amount of the change, the effect on future periods, if practicable to estimate. Otherwise, a statement that the future effect is impracticable estimate. So you should show the effect, the amount of the change and the effect on the future periods, unless if it's impossible to estimate the future periods effect. But if it's possible, you should always state. Right. Any questions? Right. So want to look at the change in accounting estimate. So normally the change in accounting estimates will be regarded as the difference in amounts recognized with the change and without the change. So we're saying we check what could have been the amount if we recognize the change, and what could have been the amount if we don't recognize the change. The difference between the two figures will be our change in accounting estimates. Okay, it will become clearer when I do examples here. Right, so let's go back to our document. Right. Let's start with number 1. Oh, this is number 3, sorry. Right. Yeah, that's question 2. Right, Megaworld Limited acquired all their assets on 1 January 2016. On this date, all the assets were available for use as intended by management and also brought into use. No other assets were acquired or sold since 1 January 2016. The following information is an extract from the asset register of Megaworld, which you can assume to be correct before taking into account the information below. Right, on our question date. So, okay, this is from our year end. Let's see our year end. It's 2018. So we're given our carrying amount, tax base, carrying amount, tax base for both days. Right, on acquisition date, it was determined that the delivery vehicles and machinery had a useful life of 5 years and 4 years respectively, and both had a residual value of nil. Depreciation on property, plant, and equipment is accounted for in accordance with the straight line method over the useful lives. The SA Revenue Service grants the following tax allowances: a tax allowance on delivery vehicles over 4 years, tax allowance on machinery over 5 years. This is where we want to, so please let's attend to this. After the draft financial statements for the year ended 31 December 2018 had been prepared, the directors of Megaworld Limited decided to increase the residual value of delivery vehicles from nil to 30 million. This change in the residual value of the delivery vehicle has not yet been accounted for yet in the accounting records of Megaworld. Right, you can see that. So the issue is on delivery vehicles, not machinery. Machinery is okay. So these delivery vehicles, prior to this year, they used to use a residual value of nil, but now they are now they said that they should increase it from nil to 30,000. So we have to determine the difference between the depreciation before the change and the depreciation after the change. Right. So our depreciation before the change this one is not the answer, it's the working. Depreciation before the change. Right. They said they were using what? 5 years with the residual value of nil. But if you can see, we don't have the cost. We're not given the cost. We're just we're given the carrying amount here and the carrying amount in 2018. Right. We know that if there are no assets bought or sold, we know that the difference between our carrying amount will be our what? Our depreciation, unless if there were assets sold or bought. But here we're told that Megaworld Limited acquired all their assets on 1 January 2016. So all of them were acquired on 1 January 2016. So to find our depreciation, we can just find the depreciation, the difference between this carrying amount in 2017 and the carrying amount in 2018. You only do this if there are no disposals and no acquisitions. So say 1,080,000 minus 720. Right, what do we get? Thank you. 360,000. Then depreciation after the change. Right. Your depreciation after the change right. The new depreciation will be calculated based on the carrying amount at the beginning of the year. And not on the original cost. Remember that we normally provide depreciation based on the normal cost, unless if we are using the reducing balance. But now, if there's a change in accounting estimate, you now calculate on the carrying amount at the beginning of the year to ensure prospective application. That will ensure that, remember that according to the requirements of IAS 8, a change in accounting estimate, you have to account for it prospectively. You don't have to adjust the previous years. So that means our depreciation, we are now going to calculate it based on the 2017 carrying amount of 1,080,000, the new depreciation. Right. Remember, this one is after this is the carrying amount that they got without taking the change into account. So here is before taking the into account the information below. So this one, the 720, they got it after accounting for depreciation without taking the change into account. So now when we take the change into account, you calculate based on the carrying amount at the beginning of the year. Remember, the end of last year is the beginning of this year. Right. Want to know, and right. And the depreciation will be based on the remaining useful life, not the original useful life. So I want you to see, according to them, the original useful life for delivery vehicle was 5 years. And this was bought on 1 January 2016. By 31 December 2017, it had already gone for 2 years, 2016 and 2017. Be very careful that it was bought on 1 January 2016. So there was the full of 2016 and the full of 2017. So by the time that they came into this year, 2018, it had already been used for 2 years. So to ensure prospective application, we will no longer use the 5 years. We'll now use the remaining 3 years. Right. So we'll now use the remaining 3 years to calculate our depreciation. This is to adhere to IAS 8, whereby we apply the change prospectively. So we'll take this 1,080,000 and then subtract our residual value, which is 30,000, then divide by 3, because we are now using 3 years. So we'd say 1,080,000 minus 30,000 divided by 3. What do you get? Thank you. Thank you. Right. So there will be a decrease in depreciation, which is 10,000. So where we're supposed to provide a 360, we are now providing 350. Right. So we now know our change in depreciation. Then we do extract of the notes to the financial statements of what's this company? It's Mega World. Thank you. For the year ended 31 December 2018. Right, we disclose this under the profit before tax note. Then we state what happened. So we can say included in profit before tax is a change in accounting estimate of 10,000 that arose from the decision to increase the residual value of them. It was the delivery vehicles. From new to 30,000. This change resulted in a decrease in depreciation of 10,000 in the current year. And will result in a decrease in future depreciation of, right, when you increase your residual value, you are reducing the depreciation because you are saying that amount should remain at the end of the useful life. So now, if 10 was reduced this year, that means the other 20 will be reduced in previous years, in the future years, which is the 30,000, the increase in the residual value, minus the 10,000 decrease in the current year. That's how we disclose the change in accounting estimate. So first of all, you have to calculate that change. And then you go on your notes. We normally disclose it under the profit before tax. Then you state what was the change, the nature of the change, the amount, and the possible effect on future periods. Any questions? Right, so we'll move on to question 3. On 1 July 2015, Ginger Limited purchased 8 motor vehicles at a cost of 255,000 each. These are 8 to be used by their sales representatives. On this date, the motor vehicles were available for use as intended by management and also brought into use. On 1 July 2017, the directors of Ginger sold 2 of the motor vehicles used by the sales representatives. Right, our financial year is ending on 30 June 2018. So this sale happened on 1 July. So that means these vehicles were sold at the very beginning of the financial year. So on 1 July 2017, the directors of Ginger Limited sold 2 of the motor vehicles used by the sales representatives for cash. There were 8. So that means at the very beginning of the year, they sold 2, so we remained with 6. Right. The details of the sales transaction of the 2 motor vehicles sold on 1 July 2017 are as follows. Right. Sales cost carrying amount. I'm not interested in that today. Right. We're interested in this part. Right. The motor vehicles are depreciated according to the straight line method at 25% per annum. However, the directors re-estimated the useful life of the motor vehicles and determined that the useful life of a motor vehicle on acquisition date is actually 5 years due to the implementation of a new improved maintenance plan. The effect of this change has not yet been recorded in the company's accounting records for the year ended 30 June 2018. The residual value of the motor vehicles remained unchanged at nil throughout the period. The tax allowance on the motor vehicles in terms of Section 11E of the Income Tax Act is 4 years according to the straight line method apportioned for part of a year. The tax base of the remaining motor vehicles on 30 June 2018 amounted to 382,500. Ginger Limited accounts for property, plant, and equipment according to the cost model. Right, my friends. They've decided to change the original useful life. This is, you should be very careful. This is the useful life on acquisition date. That means in the beginning, they've re-estimated it to 5. How much was the original? The original was 4. How do I know? If you are using the straight line at 25%, that means the original was 100 divided by 25, which is equal to 4. So that means originally they were calculating depreciation over 4 years, but now they've changed. So what we have to do, we have to find the depreciation before the change. That is using the 25%. Then we calculate the depreciation using the revalued, the readjusted useful life to see what is the difference. That will be our change in accounting estimate. That will be our change in accounting estimate. Right. So would say right. Let's first do the calculation of the our change in accounting estimate. Right. The depreciation before the change. So before the change, they were using 25% as the depreciation rate. So that means before the change, they were using 25%. And the cost of these vehicles was 225,000 each. And you should know that the effect does not affect the 2 that were sold. The 2 that were sold at the very beginning of the current year, so they don't have depreciation. So we're only interested in the remaining 6. But if these 2 had been sold during the year, they were also going to be affected. But because they were sold at the very beginning of the year, then we don't mind about them. So we'll only talk about the 6 vehicles. So the depreciation before the change will be 255,000 times 6 times 25%. So it will be 255,000 times 6. 6 is for the number of vehicles times 25%. I've removed the 2 that were sold. What will we get? $382,500. Then the depreciation after the change. So we have to remember that we apply prospectively. So now we have to check how many years are remaining. We don't have to go back to the 5 years. We have to find how many years are remaining, right? So if they are saying the original is re-estimated to 5, these were bought on 1 July 2015. And we are now, they'd gone up to 2017, up to the beginning of this year. So 2 had gone. So we remain with 3. So you should be very careful there. You have to check from acquisition until the beginning of this year, 1 July 2017, the beginning of this year, the vehicles had gone for 2 years. So if we've re-estimated the original useful life to 5, so that means we've remained with 3. So you count from the beginning of the year, the remaining years from the beginning of the current year. You take out all the years that you've gone. So it's 5 minus 2, that means 3. So you have a end. We'll no longer, remember that we'll no longer calculate on the original, of course, we'll now calculate on the carrying amount. So maybe we have to calculate the carrying amount on 1 July 2017. So, okay, let's calculate the carrying amount. Cost of these vehicles was 255,000 times 6, which is what? What do we get? That's 1,530,000. Then we get our accumulated depreciation. That is by 30 June 2017, the end of the previous year. So to find that accumulated, the carrying amount at the beginning of the year, remember that we'll be using the old method of 25% because they did not yet what? They did not yet change the method. Multiplied by the 2 years. The 2 years, that means from acquisition, 1 July 2015 up to 30 June 2017, the end of last year. And we will not be using the new useful life, we'll be using the original method, which was 25%, which was 4 years, because they not yet changed the useful life by then. What do we get? $765,000. Right. Then we get our carrying amount at the beginning of the year. Remember, the carrying amount at the end of last year will be the carrying amount at the beginning of this year. So please always know that if there's a change in accounting estimate, the change will now be calculated on the carrying amount at the beginning of the year. So here we'll not calculate the depreciation on the original, we'll calculate it on the 765. So say 765,000 divided by 3, the remaining years. What do you get? $255,000. Right, then we get our decrease in depreciation. So our depreciation is decreasing. which will be that's 127,500. So would say right. Oh, sorry, we have to set our heading here. Not the financial statements of Ginger Limited for the year ended 30 in 2017. Right. Right. So we have included in profit before tax is a change in accounting estimates of 127,500, which resulted from the decision to change the original useful life of the motor vehicles to 5 years on acquisition date. And not 4. Due to they gave us a reason if there's a reason there. The implementation of a new improved maintenance plan. Maintenance plan. The effect of this change. On the current year financial statements. As a decrease in depreciation of 127,500 and will result in an increase in depreciation of future periods by 127,500. So only the useful life is the one that you do what we did that at the time of subtracting, saying the 20 minus 10. If there's a change in useful life only or depreciation method only without changing the residual value, whatever decrease in this year will be increased in the future periods. If there's an increase in this year, then there will be a decrease in the future periods. Because whatever amount which was not depreciated, that 127 will be depreciated in future. So if there's a decrease in the current year, there will be an increase in the future years. If there's an increase, that means we have depreciated an amount that we could have depreciated in future, so there will be a decrease in future. Any questions? Right. Then we have this one was an error. All right, let's go to number 6. Plastics Limited, we read that question earlier on, but our let me just give the main pointers. Our year is ending on 28 February 2017. 28 February 2017, 2018, sorry. Then we are told that we are told that on 1 October 2017, the carrying amount and tax base of manufacturing equipment acquired on 1 October amounted to 480. Or the year ended September, not what I was saying. Where did I get my February? This is a mistake, it's September. Right. So on 1 October 2017, that is the beginning of the year. The carrying amount and tax base were given, they were 480 and 240. Depreciation and the tax allowance on the manufacturing equipment for the current year both amounted to 240,000. Plastics Limited depreciates manufacturing equipment at 20% per annum according to the straight line method. Right. The SA Revenue Service grants a Section 12C allowance on manufacturing equipment in terms of the income tax account, allowing a 40% deduction in the first year it's brought into use, and thereafter a 20% deduction per annum for the next 3 years. The Section 12C allowance is not apportioned for part of a year. On 3rd September, the directors of plastics re-estimated the useful life of the manufacturing equipment and determined that the useful life on acquisition date of the manufacturing equipment is 8 years. Due to the implementation of a new improved maintenance plan, the residual value of the manufacturing equipment remained unchanged at new. Right. That is the issue there. That's what we have here. So we have to calculate the depreciation before the change and then the depreciation after the change. Right. Right. My friends, this calculation, I repeat, you will not have to disclose it. It will be, you show it separately. It's just part of workings. Depreciation before the change. We should be very careful here. Right. Remember that they'd already calculated it as 240. But using the 20%, but they'd incorrectly expensed this 500,000. So we have to make sure that we add that up. So it will be 240,000 plus 500,000 times 20%. The depreciation on the one that remember this one, that there was a vehicle that which was recorded as an expense instead of an asset. So that means they not included that depreciation in the 240 that we have above there. So we have to take that 240 and then we top up with the depreciation on the other vehicle. Right, what do we get? Right, we have 148,000. Someone is saying 340, someone 148. Which one should I take there?
It's 340.
Okay, I think 340 will be okay. I think our colleague made a mistake of multiplying this 20% with the 240 plus 500. The 20% is only multiplying the 500. The 240 is the depreciation for the other vehicles already calculated. Right. Then our depreciation after the change. Now we should be very careful here. Right. We'll have first on the this asset here. Remember, we'll now calculate on these ones, which are the 240. We have to find out. They are now saying that they were using 5 years. How many years had gone? They had been bought in 2014. 2014 to 2017, 3 years had gone. So the remaining is 5. Because they were using 5 years in total, but they are now changing to 8 years. So since they'd been bought in 2014 to 2017, 3 years had already gone. So out of these 8 years, we now remain with what? We now remain with 5. So and our depreciation will be calculated based on the carrying amount. It will be calculated based on the carrying amount of 480,000. So we'd say 480,000 divided by 3 by 5. Sorry, what do we get? $96,000. Thank you, guys. Then the other one. This was for the other vehicles. Then this one for 500. Remember that 500, the depreciation 500,000 times 20%. The depreciation for the first year is equal to 100,000. We've already calculated in the other question. So here we would say a 500,000 minus 100,000 divided by, but this one is not remaining with 5 because remember it was bought on 1 October 2016. So this one had only gone for 1 year. It had only gone for 1 year. It was up to 2017. So it's remaining with 7 out of the 8. Then we divide by 7. What do we get? we'll get 57143. So our depreciation after the change would be 153,143. Then we get our change in accounting estimates. Then we'll have our profit before tax. Then we say profit before tax we can say included in profit before tax is a change in accounting estimates of we're supposed to subtract here. $186,857, which resulted in changing the original useful life. Right. Of manufacturing equipment from 5 years to 8 years. To an improved maintenance plan. This change in estimated useful life resulted in a decrease of 186,857. In the current year, and will result in an increase in future depreciation by 186,857. This is how we prepare this note. Any questions? If we don't have any questions, please, guys, I think because of the time, I can't move on to provisions. It was my wish, but I can't move on. So I'll organize another session on provisions events after the reporting period. But please read those notes that I gave you so that we just go straight to the questions. We have to be faster considering that our timetable is now out. Thank you very much. Sorry for disturbing your holiday. Enjoy your holiday. God bless you richly.
Thank you.